Welcome students. Now we came to the comparables or relative valuation approach. Before this we have seen the dividend discount model or dividend growth model. In dividend growth model we have seen uh, the uh, no growth, constant growth and multiple growth. I will discuss once we finish the chapter. I will tell you, I will show you in spreadsheet how we can do for multiple growth rates, multi-stage growth rates. Maybe first 5 years, 30%, next 5 year, 20%, next 5 years, 15%, next 5 year, 10%, then it will come to 5%. There are 5 stage growth model. We can do in the spreadsheet just like this. I will show you at last. So before that, let me complete the relative valuation model. So I hope the multi-stage growth model is clear. The same way you can go for, we have seen single stage, that is the perpetuity or constant growth model. Then we have seen the multiple growth rates. But we have seen two-stage growth rates, two different companies scenario we have seen. Same way we can do for 3 stage, 4 stage and multiple stage growth rates. I will show you how it is done. But now we will go for the relative valuation or comparables. There are many different comparables available like price earning ratio, price to book value ratio, price to sales ratio, price to cash flow ratio, enterprise value ratio. There are multiple number of comparable ratios are available used by the analyst. The more you use, the more concrete kind of conclusion you can give. So many analysts use many different comparables. Like I told you now, 6 or 7 ratios I told you. Price earning ratio, price book value ratio, price to sales ratio, price to cash flow ratio, price to enterprise value ratio or enterprise value ratio. So these are the many different ratios are being used as comparables. We will discuss here two. One is price earning ratio, the other one is enterprise value ratio. Price earning ratio. Here, this is calculated. The earnings will be used. The Wall Street Journal uses the 4 quarters earning as the year's earning. And the formula here is price earning ratio means price divided by earning per share. Earning per share, how we do? We calculate. We know in the first, in the second chapter only we could know how to calculate the earning per share. Net income divided by number of shares will give you the earning per share. Now, price will be available in the latest price in the exchange. So, price earning ratio using the simple formula price per share divided by earning per share. If you are using the current price per share divided by the last 4 quarters earning per share, then you are using the PE ratio trailing. That is called PE ratio trailing. If you are calculating the price, expected price divided by price per share divided by expected earning per share or EPS 1, it is called forward PE ratio. So these are the different kind of practices being done in real practice by the analysts. So the basic ratio, the basic formula is price per share divided by earning per share. Now we come to the enterprise value ratio. You know, price earning ratio focuses on what? Focuses on the equity, price per share divided by earning per share. Both numerator and denominator are talking about per share. Price per share means the share price divided by earning per share. So both are focusing on the equity. But what if we want the value of the whole company, value of the whole firm? In that case, we have to go for the enterprise value. We have seen enterprise value in the chapter 3. Enterprise value is equal to, that is the financial statement analysis chapter 3. We have seen how to calculate enterprise value. Remember students, enterprise value is equal to market value of equity plus market value of debt minus cash. Second and third component of this ratio is equal to net debt. Market value of debt minus cash is equal to net debt. So market value of equity plus net debt is equal to enterprise value. Or the whole expanded formula is market value of equity plus market value of debt minus cash. Once you get the enterprise value, you can use it to calculate the enterprise value ratio by using the formula enterprise value divided by the whole cash flow to the enterprise, that is EBITDA, earning before interest, tax, depreciation and amortization. So how you get the EBITDA? EBIT plus depreciation and amortization will give you the EBITDA. So enterprise value divided by EBITDA will give you the enterprise value ratio. So I hope this is clear to all of you how to use the relative valuation or the comparables to get the valuation of the stock and valuation of the firm. Valuation of the stock you can do through the price earning ratio. Valuation of the firm you can do through the enterprise value ratio, like enterprise value divided by EBITDA. Now we will go to the next level of discussion, that is valuation of stock using free cash flow approach. Of course, detailed discussion is not given in this chapter, because this chapter is mainly focusing on the relative valuation and the dividend discount model. So in chapter 5 and 6, when we learned about the capital budgeting and all, we learned that the value of a project, that is net present value, was discounted value of the cash flow it generates. The farm value is the consolidated present value of the cash flow from all of its projects. We have seen in detail this kind of thing in your capital budgeting and in your bond valuation, chapter 5 and chapter 5, that is capital budgeting, we have discussed in detail about the capital budgeting. Of course, chapter 6 we have not included in this course, but both of them are giving. Chapter 6 is risk analysis and the capital budgeting, and more kind of scenarios and sensitivities are being involved. So in both the chapters we have only calculated the net present value. How we calculated? We have to always try to calculate the free cash flow. How we calculated the free cash flow? We calculated the once you get the net income, we added back the depreciation, we deducted the capital investment or capital spending, then we made adjustment for the changes in the net working capital, then we get the free cash flow, isn't it? Once we get the free cash flow, we have discounted at the cost of capital, then we get the NPV. If NPV comes positive, we invest it or we go green, or else no. So this we have discussed in detail in those chapters. So here it is not being discussed in detail. Now let me stop here for taking your questions. Just a minute.